Hello, everyone, and welcome back to Market Week in Review. This is the episode for the week of November 22nd, 2024. On today's episode, there are three things that I would like to discuss. The first is the most recent inflation data out of Canada and what the data means for the Bank of Canada. The second is a look at some of the latest developments in the U.S. earnings season. And finally, I want to touch on a topic that doesn't necessarily get the most attention amongst investors, but can nevertheless still be an interesting factor to consider. So stay tuned and find out what that third topic is. All right, so let's start with Canadian inflation. This week there were two important pieces of inflation data. The first was the CPI, or the Consumer Price Index, and the second was the PPI, or the Producer Price Index. So on the CPI, what we saw was that on a lot of different measures, consumer price pressures were a little bit hotter than expected, whether it was the headline CPI coming in at 2% year over year, or whether it was some of the Bank of Canada's preferred measures of core inflation, like CPI trim and CPI median, also coming in a little bit hotter than consensus expectations. Ultimately, when we look at the main measure of core inflation that the BOC focuses on, which is the average of CPI trim, CPI median, and CPI common, what we see is that this average measure has accelerated to 2.4% year over year in the month of October, as compared to 2.3% in the month of September and 2.2% in the month of August. So although core inflation rates in Canada have come down from their peak, in recent months it does appear that consumer price pressures have been a little bit on the sticky side. And investors will be carefully monitoring whether those developments are more of a temporary setback or are something potentially a little bit more worrisome for the Bank of Canada. Now, the second report on inflation we got this week was the PPI. And the PPI for Canada also came in hotter than consensus expectations. So when you combine the results of those two inflation reports for Canada, what we saw was that market participants started reducing their expectations about the size of a December rate cut. Market participants are now heavily leaning towards the idea that the Bank of Canada might only cut interest rates by 25 basis points in December instead of a supersized 50 basis point rate cut. Now, from our perspective here at Russell Investments, we're still keeping an open mind as to what the Bank of Canada might do in December. The Bank of Canada will still get more data before they have to make their decision. The Bank of Canada is going to have more GDP data. It's also going to get a key jobs report at the beginning of December that will show what is the latest health of the labor market. So all of those additional factors could still influence whether the Bank of Canada opts for 25 versus 50. So the second topic I want to talk about, let's shift gears a little bit, is now a look at the U.S. earnings season. And in general, Q3 has been another robust quarter for U.S. publicly traded companies. It was good to see that headline S&P 500 earnings growth was around 10% year over year, which is pretty healthy. Even when we exclude the impact of some of those mega-cap tech names, we still see earnings growth of around mid-single digits, which is once again still pretty resilient. Now, although a lot of people this week were probably focused on the earnings report out of a particular large mega-cap tech company, I was a little bit more focused on two consumer-facing company earning reports instead. And these two large U.S. retailers had a bit of a contrasting development in their earnings report. So one beat expectations and struck a positive tone in guidance. One missed expectations and was a little bit more downbeat in its guidance. And ultimately, what this goes to show is that the consumer sector, even though consumer spending thus far has still been resilient, it is still going to be an interesting watch point to see whether that resilience can still hold up in the fourth quarter and into 2025. Now, as a reminder, our base case here at Russell Investments is that we think that the U.S. economy can most likely avoid recession, but in order for the U.S. to be able to achieve that soft landing, we do need to see consumer growth and consumer spending still hold up. So that's why I'm going to be very focused on the consumer sector into the Q4 reporting season, which we'll get at the start of 2025. Finally, the last topic I want to discuss is a topic that doesn't necessarily get the most media coverage, but nevertheless can still be an interesting development for investors, and that is credit spreads. Credit spreads are basically a measure of how much incremental return investors could potentially get for investing in corporate bonds over government debt. And what we're seeing is that credit spread for US companies has compressed to amongst some of the narrowest levels in recent history. For example, the US credit spread for high yield bonds has compressed to under 300 basis points. Now, when we look at the health of US companies, we do think that US corporates generally have robust balance sheets, and so that could explain some of the compression in credit spreads. And when we look at, for example, market implied measures of recession risk, the market generally believes that the chance of the US economy heading into recession in the near future is relatively low. However, from our perspective here at Russell Investments, we still think that the probability of the US economy tipping into a recession is still somewhat higher than normal, and so there could be a chance that these credit spreads might widen out in 2025. We're not yet at a point where we would say that investors should be thinking about tactically underweighting corporate credit because we don't yet see signs of an unsustainable extreme in the credit markets. But nevertheless, it is important, we think, for investors to stay disciplined and be aware of some of these developments in the corporate credit market as well. That's all for us. Stay tuned for the next edition of Market Week in Review. Thanks, everyone.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.